Welcome to the deep dive. Our mission here is simple. We take your sources, cut through all the noise, and pull out the key insights you need. Basically, helping you get informed fast.
And today, we're jumping into what looks like a really, really crucial week for the financial markets.
Absolutely pivotal feels like the right word. We're basing this on a strategic briefing that analyzes this coming week, June 16th through the 20th, 2025.
That's right. And the core idea, really, is that this week is a major test, a kind of crucible, you could say.
A test for what, exactly?
Well, a test for what the market currently believes about the economy, about inflation, about where interest rates are headed.
And the market's feeling pretty good right now, isn't it? Like, the whole soft landing idea seems baked in. Inflation cools off, growth holds up okay.
Exactly. That's the dominant narrative. But this week, that optimistic view is going to clash, potentially quite sharply, with some key economic data and, probably most importantly, with the Federal Reserve itself.
Okay, so that's the tension. Optimism meets reality check.
Precisely. It's a sharp confrontation of ideas, as the sources put it. So our goal here is to unpack the specific events, understand why they matter so much right now, and explore what the different outcomes could mean for your investments for different sectors.
Right, because this week could really shift things. So where should we start? Maybe the market backdrop. Like, where are we standing as we head into Monday?
Good place to start. We're entering the week from a position of, well, pretty high confidence in the market, maybe even bordering on complacency. Meaning the market seems priced for things to go almost perfectly. It assumes inflation keeps coming down smoothly and that company earnings stay strong, even with rates being higher.
And you can see that in the numbers.
Yeah, you definitely can. Take the S&P 500's forward price-to-earnings ratio. That's looking ahead 12 months. It's sitting around 21.6 right now.
Which sounds high.
Well, compare it to history. The 5-year average is just under 20, like 19.9. And the 10-year average is lower still, around 18.4. So yeah, 21.6 is noticeably above those levels.
Okay, so that high PE ratio isn't just abstract. It means something.
It absolutely does. It implies investors are really confident in that rosy outlook. They've basically priced in a lot of good news already.
Which leaves very little room for error. Or bad news.
Exactly. Not much wiggle room. Any kind of negative surprise, anything that deviates from that smooth path, could get a pretty strong reaction.
Okay, that definitely sets the stage for why this week's data is so critical. Let's talk about that macroeconomic pulse check. What are the vital signs we're watching?
These aren't just numbers on a screen. They're real-time snapshots of economic health. And crucially, they feed directly into how the Fed thinks. They can either confirm the market's optimism
Or throw a wrench in the works.
precisely, challenge those assumptions head-on.
And the sources seem laser-focused on one report in particular this week.
Oh, absolutely. Tuesday, Made retail sales, that's the big one, arguably the most critical piece of data this week, maybe second only to the Fed meeting itself.
Why retail sales, though? What makes it the main event right now?
Because it's our best direct look at consumer spending. And consumer spending, as you know, is the engine of the U.S. economy. It drives like 2/3 of it.
So it tells us about Q2 GDP.
Definitely a key input for Q2 GDP estimates. But also, it tells us if demand is actually cooling off, which is vital for the inflation picture. Is that side of the equation easing up?
And there's some real debate about what the number will actually be.
Significant uncertainty, yeah. The general consensus among economists is for a drop month over month, maybe minus 0.5%.
Okay.
But interestingly, the economists over at BofA, they're forecasting flat, zero change. That difference alone tells you there's potential for a real surprise compared to what the market expects.
And the sources describe this as a double-edged sword. What does that mean here?
It really is tricky. Let's say the number comes in stronger than expected. Maybe it's flat, maybe even slightly positive.
And okay, so people are still spending.
Right. Which sounds good, but it challenges that smooth disinflation story. It suggests demand is sticky, inflation might be harder to tame, and that likely forces the Fed to stay more hawkish.
Meaning fewer rate cut signal down the road.
Exactly. Fewer cuts priced in for later this year or next. That's one edge.
And the other edge? What if it's weaker, like worse than the negative 0.5% consensus?
Well, that would certainly validate the idea that the economy is slowing and needs rate cuts, so bonds might rally on that.
But there's always a but.
But it could quickly spark recession fears. Remember, those Q2 earnings estimates for the S&P 500, they've already been cut pretty significantly from over 9% growth down to under 5%.
Ah, so a weak consumer number makes those earnings forecasts look even shakier.
Precisely. It hits the growth and earnings outlook hard. So stocks could sell off even if the bond market likes the prospect of rate cuts. It's tough. Too strong is bad for rates. Too weak is bad for growth.
Walking a very fine line. And you mentioned the control group number within that report is key.
Yeah, that's the one that feeds directly into the GDP calculations, stripping out volatile stuff like cars and gas. So economists watch that closely.
Okay. Beyond retail sales, what else is on the macro docket?
Well, Monday kicks off with data from China industrial production and retail sales. That often sets the global risk mood for the week. Weak China data can suggest deflationary pressures hitting commodities, energy, material sectors.
Got it. And later?
Tuesday, we also get U.S. industrial production, a look at manufacturing. Wednesday, housing starts and building permits, very important for that rate-sensitive sector just before the Fed speaks.
And jobs data.
Also Wednesday, initial jobless claims. Always important for the labor market picture. Is it cracking, which the Fed might see as dovish, or staying strong, supporting patience on cuts?
Okay, so that covers the big economic data points, but the sources also emphasize looking at individual companies reporting earnings this week. How does that fit in?
Earnings give you that ground-level view, a bottom-up check on whether those big macro stories are actually playing out for real companies. And while it's not peak earnings season, the few reporting this week are highlighted because they're like canaries in the coal mine for specific areas.
Starting with Lennar on Monday afternoon?
Yep, Lennar, ticker LEN. Huge home builder. They give us a direct read on how high mortgage rates are hitting housing demand and profitability. Consensus is looking for earnings per share around $1.97, revenue near $8.24 billion.
And that earnings number is expected to be down quite a bit from last year.
Yeah, the briefing notes it's a significant year-over-year expected drop. Really underscores the pressure.
So beyond just the headline EPS and revenue for Lennar, what are the details to watch?
You really want to dig into their new orders and their backlog that tells you about future demand. Also, average selling price, ASP, and their gross margins. Are they having to offer lots of incentives, or can they hold prices?
And what they say matters too, right? Management commentary.
Hugely important. What are they hearing about buyer traffic? Are people canceling contracts? Their insights will move the whole home builder sector. The ETF is XHB, and honestly, it gives the Fed some useful real-world color, too.
Okay, shifting from housing to the consumer later in the week, Friday morning looks key with Kroger and Darden restaurants.
Yeah, this is a great comparison the briefing sets up. You've got Kroger, KR, which is mostly non-discretionary stuff, groceries, essentials. Then you have Darden, DRI, think Olive Garden, Longhorn Steakhouse, that's discretionary spending, especially for the middle-income crowd.
So what are we looking for from each of them?
With Kroger, it's things like same-store sales, any comments on food inflation sticking around, and critically, are people trading down to cheaper store brands?
And Darden?
Traffic. Simple as that. Are people still going out to eat at their restaurants, or are they cutting back?
And the briefing highlights a potential bearish signal if you put their results together.
Exactly. Imagine Kroger reports okay numbers.
Yeah.
People still need groceries. But Darden shows a big drop in traffic or gives a really cautious outlook.
What does that tell you?
It suggests consumers are getting squeezed. They're prioritizing necessities and cutting back sharply on the extras like eating out. That would be a clear negative signal for the broader consumer discretionary sector, the XLY ETF, while maybe being okay, or even slightly positive for defensive consumer staples, XLP.
Makes sense. And also on Friday, Accenture reports.
Right. Accenture, ACN, huge global consulting and IT services firm. Their results are often seen as a leading indicator for how confident corporations are feeling globally, and especially how much they're planning to spend on technology.
And the key metric there is?
New bookings growth. That's the #1 thing to watch.
Okay.
How much new business are they signing up?
And the sources connect this directly to the huge AI theme that's been driving the market.
Yes, this is where it gets really interesting. A lot of the market rally, especially in those big tech names, the Great Eight or whatever you want to call them, is built on the promise of AI growth.
Right. Future potential.
Accenture's report is like a real-world stress test for that idea. Is that excitement actually turning into companies spending big bucks on AI-related consulting and IT projects right now?
So if Accenture's bookings are strong, especially the AI-linked stuff,
That helps validate the whole AI spending cycle story. It suggests the promise is starting to hit the bottom line for service providers. That would be a positive for the tech sector. You don't really think XLK, the QQQ, and might help justify some of those high valuations we talked about.
but the flip side, if bookings are weak or they sound cautious,
Then it suggests maybe AI isn't translating into widespread big spending just yet, at least not at the pace the market hopes. That could be a catalyst for investors to rethink the AI theme and maybe question if those tech valuations have gotten ahead of themselves. Consensus for ACN is around 3.27 for EPS, $16.7 billion revenue, but really, it's the bookings and the commentary that matter most.
Okay, so we have the data pulse check, the corporate health check through earnings, and it all kind of leads up to the main event this week, the Federal Reserve. Their meeting wraps up Wednesday.
That's the centerpiece. And just to be crystal clear, nobody expects them to actually change interest rates this meeting. The odds of a hold are like 99.7%.
So the decision itself is basically a done deal.
Completely. All the focus, absolutely all of it, is on the stuff around the decision. The statement language, the updated economic projections, the SAP, which includes the famous dot plot, and of course, Chair Powell's press conference afterwards.
Okay, the dot plot. Just remind us quickly what that shows and why it's such a big deal this time.
Sure. It's basically a chart where each Fed official puts a dot showing where they personally think the Fed funds rate should be at the end of this year, next year, and longer term. The market really zooms in on the median dot, the middle forecast, especially for year-end 2025.
Why 2025 specifically?
Because that gives the best sense of how many rate cuts the committee as a whole anticipates over the next 18 months or so.
So if that median dot moves higher compared to the last time they released it in March, that's a big deal. It signals the Fed collectively sees fewer rate cuts ahead than they did just 3 months ago. That would absolutely be seen as a hawkish surprise. It could definitely rattle bonds, push yields up, and hit stocks, especially growth stocks that are sensitive to higher rates.
And then comes Powell's press conference Wednesday afternoon.
2:30 p.m. Eastern. That's his chance to frame the decision, add context. He'll get hammered with questions about inflation's last mile, what exactly needs to happen before they cut rates, how he sees the job market.
And his tone matters as much as the words.
Oh, absolutely. His tone, any little off-the-cuff remarks, the way he answers markets, analyze every nuance, looking for clues about future policy direction.
Now, there's also this weird calendar thing happening around the Fed meeting.
Yeah, it's actually pretty significant for how markets might trade. The Fed announcement and Powell's presser wrap up late Wednesday afternoon.
And then Thursday.
Markets are closed all day, Juneteenth holiday.
Okay, so you get this major news event and then everyone just stops trading for a day. Exactly. Which can sometimes lead to exaggerated moves right after the announcement on Wednesday as people rush to get positioned before the close, maybe on thinner liquidity. Then everyone has Thursday to digest it all away from the screens.
So Friday could be interesting when markets reopen.
Could be. The reaction Friday might be more considered. It could confirm Wednesday's move or maybe even reverse some of it as institutions put their orders in. Definitely adds a layer of potential volatility to the end of the week.
Okay, let's try to pull all these threads together. We've got the data, the earnings, the Fed. How do these potentially combine? What are the big picture scenarios for the market?
This is where that sharp confrontation of ideas really plays out. Depending on which way these key events break, we could see the market's current soft landing story get reinforced or potentially get blown up.
So let's start with the upside. What's the best case bullish scenario for the S&P 500 or the NASDAQ this week?
That's the soft landing confirmed scenario, as the briefing calls it. This looks like retail sales shows that modest cooling we talked about, maybe down a bit, maybe flat, clearly slowing but not crashing.
Okay.
Then the Fed's dot plot comes in pretty much aligned with what the market already expects for rate cuts, or maybe even a touch more dovish. And Powell sounds fairly upbeat about inflation making progress.
And the market reaction.
That validates the narrative. It reinforces the Goldilocks view. Could easily see the S&P and NASDAQ push higher, maybe even see leadership broaden out a bit beyond just the mega caps. It's basically the outcome the market seems positioned for.
Okay, now the main bearish case.
That's the hawkish repricing. This gets triggered by, say, retail sales coming in surprisingly strong, maybe even positive growth. That fuels fears that inflation is too sticky.
And/or
The Fed's dot plot comes out clearly hawkish, signaling notably fewer rate cuts ahead. Maybe that 2025 median dot ticks higher.
a double whammy. What's the impact?
That could be pretty rough for both stocks and bonds. Bond yields would likely rise, hitting equity valuations hard, especially growth sectors like Tech XLK, QQQ, which are really sensitive to higher rates. And given that elevated PE ratio in the S&P, the market's vulnerable to that kind of rate shock. Could see a quick sell-off.
And naturally, different sectors will feel these scenarios very differently.
More absolutely. Tech, as we said, is ground zero for Fed hawkishness sensitivity. Accenture's report adds a company-specific layer there. Then you've got consumer discretionary, XLY versus staples, XLP, classic risk on, risk off. Weak consumer data, weak Darden, bad for XLY, maybe good for XLP.
And the most rate-sensitive areas.
Real estate, XLRE, and the home builders, XHB, they're right in the crosshairs. A hawkish Fed is terrible news for them. You've got housing starts data Wednesday, Lennar earnings Monday, and the Fed Wednesday. It's like a convergence of catalysts for that group.
Don't forget energy and materials.
Right, XLE and materials. They'll be sensitive to that China data early in the week and just the overall global growth outlook that emerges from all this.
Okay, so summarizing the key risks and opportunities from the source material, it really feels like a showdown week.
It truly does. The number one risk seems to be that hawkish Fed colliding with what might be a complacent market. With valuations high, price for good news, a hawkish surprise from the dots or Powell could trigger a fast de-risking. Selling bonds, selling stocks, that's a major potential downside.
And the main opportunity on the flip side.
That's the Goldilocks confirmation. Data shows gentle cooling, Fed signals cuts are coming, market expectations get validated. That could fuel a strong rally, maybe broaden it out. Basically, the green light for taking on more risk.
But there was also that hidden risk mentioned, something less obvious.
Yeah, the consumer cracks. This is where retail sales really misses badly, and that weakness is confirmed by poor results or outlooks from Kroger or Darden. The story shifts fast from soft landing to, recession might be coming because the consumer's pulling back hard.
And even if that makes the Fed more dovish, which might help bonds.
The hit to earnings expectations could be severe enough to pull stocks down sharply anyway. It attacks the growth part of the equation rather than the rate part. Different path, but still potentially painful for equity investors.
Wow. Okay, so wrapping this deep dive up, it's crystal clear this is not just another week. It's a fundamental test, a crucible for the market's main story right now about the economy and rates. It really forces that confrontation between different possibilities.
Couldn't have said it better. And having this framework helps you know what to watch and why it matters. So keep your eyes peeled Tuesday for retail sales. Then Wednesday, it's all about the Fed dots and Powell's presser. And Friday, you get those corporate reality checks from Kroger, Darden, and Accenture.
So final thought for you, our listener, to chew on as this plays out. We've talked about the bullish case, the hawkish repricing, and that hidden risk of the consumer cracking. Given where the market seems to be positioned, leaning towards that Goldilocks outcome, which of these potential scenarios holds the most power to genuinely surprise investors this week?
Yeah, that's the key question, isn't it? Since the market seems braced for good news, any significant deviation, especially a clearly hawkish Fed or clear signs the consumer is buckling, that's where the potential for a rapid, sharp reaction probably lies. Precisely because it would be such a surprise relative to current positioning.
A really fascinating and potentially volatile week ahead. If you want the fastest updates and analysis like this, helping you make sense of these key moments, make sure you subscribe to The Deep Dive.